Do you think we've thrown in the towel on a V-shaped recovery? I mean, it's the language that's being spread around liberally. Nouriel Roubini, and we'll hear more from him later, says we are delusional in that belief.
One of the things that we've underestimated since the beginning of this epidemic, has been the extent of where it could go, how fast it could spread. In the beginning in January, when it was first announced, the idea was, with most market participants, was containment was taking place, that China was actually taking action to contain the virus. What we're seeing now is most of the G10 are actually admitting that we're beyond that point, and now we have to actually live through this virus over the next month, 2 or 3. So that there is now a very different shift in the focus from being from China now to actually a global epidemic. And that basically entails a very different perspective from what we had a month ago. So I think we've underestimated where we were, and now we're just coming to grips with where we're going.
Okay, so if we're at the start of a new paradigm, let's say in the S&P 500, let's use that as our benchmark, okay? The fastest retracement from a record high to a decimation of $2.5 trillion since 1927. Goldman and Citi say there's worse to come. Citi say another 10% from where we are now, maybe 12%. Can you see us entering a bear market? From where we are now, we're down, there you go, we're down 6.6% on the 4 days of this week. What comes next on equities in the United States?
I think, first of all, that it's actually, for me, it's funny that most market pundits were bullish in the beginning of the year, now actually turning bearish, given that they have a great deal more research capacity and access to Asia than I could imagine. But given that where we are now, I think what we have is a setup which is actually a beautiful setup in a way for a bear market entry, in the sense that in January we saw lots of market participants and allocators actually entering the market and having missed out on the rally last year and actually entering early into buying equities. What we're seeing right now, I think, is if a monthly close.
But we're not capitulating. This doesn't. I don't
this
get
is
the
the
sense
beginning,
that we've not capitulated.
No, but we're actually entering a phase where we're no longer getting the 1 day, 2 day, Tuesday turnaround. That's gone. Now we're actually entering into the phase where, listen, I'm long. I've been long since the beginning of the year. We're not having the reversal days anymore. We're actually seeing more breakout in Europe, potentially in the U.S. And now I want to get out and watch. So what you're watching basically is people getting out of equities and actually going back to cash. So that's going to continue, I think, until we see the extent of the breakout. So that could see 20–30% in S&P over the next 2 quarters, very likely.
Okay, that's a huge cause.
It's not. I mean, you've had a bull market, which has been going on for the past decade. It's not unreasonable to expect a correction of some sort, given that you have a scenario where growth is going to be stunted over the next 2 quarters.
Okay, what does it take to deliver a 30–40% retracement in the S&P 500? What's the catalyst to give me that kind of move?
A sense of panic where the Fed, the ECB, is not willing to act monetarily to entice the market to actually buy risk. That's what we've been on the past 2 years.
You're worried the backstop isn't there. You're worried the put isn't there.
Well, I think the Fed now has a very dicey situation where if they cut, they're going to be seen as supportive of a very different mandate than what they have. They haven't seen the data yet to actually mandate a cut. So the market now has already priced in a 50 basis point cut. If they don't cut anytime soon, the market now begins to panic and believe the Fed isn't cutting, we will see a bigger sell-off.